Be good. So we're about 7 minutes into this. All right, let me start all over. Hey, friends, it's Ernie here, and this is the Zero DTE podcast or talk show. The reason why I'm calling it a podcast is that I am working on turning it into a podcast, and it will be on things like Apple and Spotify and all these other places. So it will be repurposed from here on YouTube to those places, so that if you wanted to, you could take me with you on your iPhone or Android or whatever and listen to me at some other time. So that'll be good. And a lot of work involved in doing that, so be patient with me. But for now, this is the show. And what we talk about here is the Zero DTE. More specifically, we're talking about selling premium. Selling premium in options. Now, our favorite way to do that, there's two different ways that I love to do it. One is to sell puts against various liquid stocks, things that are primarily momentum stocks, that sort of thing, and selling naked puts. So it's sort of a pure selling premium play. And then the other way is on the very last day of expiration for options on the S&P. We call that the Zero DTE. I mean, this is what most people are calling it, the Zero DTE. Now, of course, Zero DTE can apply to anything, but when you hear that, most people in the industry on YouTube are talking about doing it with the S&P. Usually they're talking about doing it with the index, the SPX, options on the SPX. I don't do that. I do not trade options on the SPX. I do it once in a while, but I don't like to. I prefer the E-mini S&P, the futures contract. And the cool thing is that unlike where most stocks have weekly expirations, the the S&P or the E-mini, the options on those also have weekly, but they have it 3 times a week. So we get 3 opportunities to trade or to sell premium right into the expiration. So we have 3 last day of expiration events every week, Monday, Wednesday, and Friday. Now this week, it's on Tuesday because of the 4th of July holiday. Hey, by the way, I hope you had a great 4th of July. I had a fantastic one. We did what we usually do. We go down to our friend's place on the water and have a nice cookout right on the beach and have a grand old time. So now that it's over, we're back to work. Unfortunately, we're in a kind of a tough spot here. We're in a tight spot. And that tight spot has to do with volatility. Right now, volatility is super, super low. Now, from a historical basis, I've seen it lower. I've seen it as low as 12, 11, even hitting 9 on the VX or the VIX, the VIX index. But right now it's right around 15 or so. And that is very low historically. And it's certainly low compared to the recent market or within the last year or so. And that's a problem. When you get that low, when you get volatility that low, it means that premium starts shrinking. It also means that the inherent edge that we have with premium or selling premium kind of wanes. It goes away a little bit. Fortunately, this only happens about 15, 16% of the time, and the rest of the time, about 84% of the time, we have what we would consider overstated volatility or overstated implied volatility. In other words, the market is looking forward and they're pricing volatility as if it's going to be much worse than it is or it eventually proves out to be. And they overstate it about 84% of the time. Now, when they do that, that means that option pricing, which is largely comprised of time and volatility, gets inflated, right? So essentially what that means from a premium selling trader is that we're selling things that are more expensive than they need to be. Now, most people are out there buying options, and essentially they're buying expensive options, Well, and we're on the other side, we're selling it to them. We're acting like an insurer of their options. So it's really a great place to be as a trader. We have an inherent edge where time is on our side as sellers, as writers of option contracts. And everybody else that's buying it doesn't. As a matter of fact, they have the exact opposite. They're always swimming upstream, swimming against the tide, swimming against the waves. So that is the edge that a premium seller has. Unlike other types of trading, which have no edge, trading like with technical analysis, any strategy that is based on technical analysis. For the most part, I'm talking about the traditional technical analysis where we, look at chart patterns and RSI and MACD and stochastic and all that other stuff. There is no edge there. There is an edge in people's mind, and those people who are practicing technical analysis. But I'm here to tell you that there is no edge. You have been successfully bamboozled by the broker narrative. And if you've heard me talk about the broker narrative, you know what that is. But just for those who don't know, brokers are out there for one purpose and one purpose only, and that is to make money through commissions. Now, brokers, for the large part, are supporting all these educational programs for traders, as well as supporting all the people who have written books and talked about technical analysis. Sell-side analysts are out there, in my view, in a unholy alliance, conflict of interest, out there pushing stocks that they know nothing about, all for the purpose of getting you to trade as often as possible. They would love you to be day traders and to go through an account. They don't care if you blow it up because they know that you'll be back. You'll come back to the casino. That's all they care about is you executing transactions. So what I'm saying is that the broker has successfully, over the past 30 years, convinced people that the only way to make money in this market is to use technical analysis and to trade like that, right? And they have been largely successful at that, where 95 to 98% of you lose all your trades, or you're not profitable. You don't maybe not lose all your trades. You win enough to give you hope, enough to give you some semblance of hope that maybe you just haven't found the right indicator or the right strategy or followed the right guru, when it's really just all kind of a ruse, right? They have successfully convinced you to convince yourself that if you just worked hard enough, if you got over the emotional calamity of trading, that if you got all that into check and was experienced enough, that you too could be successful at trading, that you could live the lifestyle. But that's all it is. It is a ruse. It is fake. There is no edge in your technical analysis. Period. End of story. Now you can, it's very easy to prove too. I mean, you can set up automated systems. You can test all of these indicators. You can test all these strategies. You cannot get any of them to work in a wide range of situations. You cannot, I'm sure that there are some ways that you can curve fit an algorithm to fit previous data, and it will work for that. But anything going forward, it won't work. It may work for a little while, then it will fall apart. Now, I've done this. I mean, I can't tell you how much effort that I've put into over the years trying to get automated strategies to work, and they don't. And it's interesting too, because I was there right from the very beginning when brokers first came online. In fact, I was like the guy who helped the brokers put their brokerage online. That's what I did for a living. I consulted to the big financial houses, places like Fidelity, Charles Schwab, as well as the exchanges, NASDAQ, the American Exchange, the NYSE. I led teams of engineers and architects that literally built out Wall Street infrastructure. And so I'm telling you, from someone who has been there, done that, knows, right from the horse's mouth, they have no interest in you making money. They only have interest in you generating transactions. All right, I've belabored that point enough. This is really not what this is about. Today, it's really about volatility. And I thought volatility was going to come back there for a while because we had a nice little pullback this morning, and it looked like all the indexes were rolling over. First, there was the Russell, then the Dow, now the S&P, right? And we were only waiting for the NASDAQ to comply, and it started to roll over. And I thought, oh, good, we're going to get a 5%, maybe a 10% pullback, and volatility will come back, and everything will be good. Because I want to practice the one thing that does have an edge, and that is selling premium in a market where it is overstated. In other words, the market, as I guess a part of human nature, consistently overstates the future. People are fearful of the future, so they always make it seem or project that it's worse than it actually is. And so premium is a reflection of that. Premium in options is bigger than it needs to be, and then it finds a way to regress back to what its normal self should be once a contract has worked its way through the market and time has passed. As an option seller, we sell that premium. We sell the expensive stuff to people who overpay for it. And we make money. That is our edge. That is our inherent edge. And so that's what this podcast is all about, selling premium, particularly selling premium on the last day of expiration. And why? On the last day of expiration? Because that's when it all comes together, and that premium, it's like the premium faucet has been turned on full blast. That last bit, that biggest chunk of premium is expelled in that last day. So we place ourselves there, ready, willing, and able to grab all that premium. Is volatility a big factor for Zero DTE? It absolutely is, and that's really why I'm talking about it today. Over the past week and a half, our trading has really kind of grinded to a halt. We've had maybe 2, maybe 3 bad trades. Now, it's possible today's trade may still work out, who knows, and abstained from at least 2 instances of trading at all. Now, this is in stark contrast to the way it has been in the previous 3 months, where we never gave up a trade and only had maybe 2 losses out of 40-plus trades. And that's because volatility was above that, what I call that line of demarcation, where the regime change. Anything above 17 on the VIX, I consider that area right there to be either the overstated or the understated regime, volatility regime. Right now we're around 15, and so we're in that what I would consider the dark area of premium, and that's the problem. Volatility, when it gets down there, it's very difficult to have enough meat on the bones. It's not overstated as it normally is, so you're losing that inherent edge. So now you're dependent solely on time and to some extent the whim of the market, where it's going to be going, and our volume profile, which helps a great deal in determining market structure. And that also adds to our edge, but without that extra premium, it makes it very difficult. So we're sitting in a situation where it takes an extra effort. Let's see. If I move like this, I become more in focus. What symbol do you watch for volatility? Oh, well, there's a wide range of things that you can watch volatility derivatives, but the easiest is just to watch the VIX, the VIX. That's the index. But you could also watch or trade any of the derivatives. Now, I don't watch those symbols because they are derivatives. They're not the actual volatility. As a matter of fact, a lot of them don't correlate directly to the day in, day out volatility very well. They're derivatives, meaning that they're usually made up of the futures, the underlying futures, either short term or longer termed, to create the product, whether it's VXX or UVXY or any of those. And it doesn't make a lot of sense to follow those because they are derivatives. You're watching a calculated event, right? Why not just watch the real thing? So we watch the VIX, the index. To a certain degree, it's okay to watch the VIX futures product because that is probably the closest thing to the VIX, of which all the other ETFs and ETNs are derived from, usually from that VIX futures product. But it makes much more sense to just follow the VIX, the index, the actual index. So that's what we do. Let's see. Do we have any other questions? Paul says, I did a lot of options courses years ago, and there was a broker at every course ready to sign us up. Like, duh. All right? I thank you for that, Paul. So what that is saying is that the courses that you took, they're not just arbitrarily put on by individual people, although there are a lot that you can take today. But most of them are put on by brokers for the express reason of getting you hyped up into believing that you can actually use their special, form of magic, their magic TA. And they're more than willing to give you a good deal to trade on their platform. And that's exactly right. That's exactly my point. A lot of people don't realize this. All the training and education that's out there was all conjured up by the brokers for the express purpose of getting you into their system, their platform, to trade and to create transactions. All right. Enough of that. So let me get back to Zero DTE. Zero DTE is a service that I run, and it's been wildly successful over the past few months. Right now, we're at a spot where it's particularly tough. But, it's really, from a trader's point of view, I guess that depends on your psyche and what you're really looking at trading. Are you looking to make money? Or is it that you have to constantly be in the game, that you have to have your fingers moving, your eyes going, do another transaction? Because that's exactly what a broker wants. They want you, if that's you. But we're more interested in making money. And so when we get to this new volatility regime, we get under that line of demarcation, trading becomes extremely difficult. So what we do is we pull back. We do much smaller position sizes, fewer of them, and we pick our spots. In the beginning, when we get into that new regime, it takes a little while getting used to it because you get into it relatively quickly because you're so used to doing all this trading that all of a sudden, bam, you're into this new regime, and it's a different story. Those opportunities that you had just on Monday are no longer there on Wednesday. So shifting gears is all part of that trading experience. So that's really what we do. That's what I do in the Zero-DTE.com service. I teach you this strategy. I coach and mentor you through this entire process. It's not a course. It is a service where my main goal is to teach you the strategy. It's not an alert service. We do have alerts, but the alerts are my trades. They are an expression of the strategy. Now, we have some members now that, aren't used to that kind of service. They're just looking for alerts. They believe that that's how you trade, that, hey, just give me the things, I'll trade them, and I'll make them work. And look, that's fine if you think you can do that. I think that you'll fail. I pretty much know that you will fail. What you need to do is understand all the nuance of this. Learning the strategy is relatively simple. Learning our analytical method, our global macro analysis, the actual edge that we have and how we put on trades, what types of option strategies that we put on. Those are the easy things. It's how you adjust your position size and frequency of trading depending on the context of the market. What's the volatility? What's the underlying nature of that market? Is it choppy, frothy? Is it smooth? Is it trending? Is it range bound? And each of these presents a different contextual landmine or field of I guess you call it the battlefield, right? And knowing that battlefield is extremely important, and how to react and how to adjust your trading, and whether or not you should be trading at all. And this is one of those times where you just sort of step back and you say, well, sorry, we don't trade. All right? Now, today we took a trade because I felt like, well, for the past 6 or 7 days, the market has been consolidating every 15 points up, right? So finally I decide, hey, I think I'll just put a real super narrow trade up there, very little money expended, and if it moves that up, then it's great. It will hit it. If it doesn't, the risk is extremely small. It's our asymmetric risk. Small risk, potentially large reward. And it didn't hit. Actually, this morning, what happened with the market, well, let's move back and look at the Globex market, the overnight market. We actually hit another new high, and it looked like we were going to go through the same process again over the 4th of July holiday. We'd start up, shoot up, move up to that next level, 15 points up. And it started up, it jetted out of the starting gate and then came straight down, which was very interesting. Now, because we put on an asymmetric trade with very little risk, it didn't hurt. Didn't hurt at all. And we get to watch it. And then, the next thing is, well, what's going to happen tomorrow? What's going to happen on Friday? Is the market going to continue down, or are we going to see another one of those little V bottoms that we get, it seems like, regularly now? And in fact, that's what happened. So far, it looks like we have another V bottom. It's going to come back up. And I think we're going to just dig right back into this same sort of low volatility regime. Now, there are ways to trade that. They don't have the same kind of edge that we had in the past, where we could go 30 trades in a row and just bang it out of the park, right? Now it's something that we have to just sort of pick our spots and be a little bit more diligent about how we do our analysis when we get in, try to spend as little time in the market and maximize our return, but we have to expect a smaller return too. And I know that that's not exactly what traders want, right? They want you to come up with the magic that shows you how to extract, 3, 10, 15 times leverage out of nothing. But that's not where we're at. That's definitely not where we're at, which is tough. So, what do? I think that what you do is that you wait for your opportunity. You wait for that right economic report that's going to cause some disruption in the market, that's going to inject a little bit of volatility. You lean back on premium selling, right, and start selling pure premium plays. You're always able to find a stock out there that has some volatility in it. When you're talking about the market, that's it. The market has its level of volatility, but the market is made up, particularly the S&P, of 500 stocks, right? There's always some stocks within the market that have extraordinary momentum or volatility that you can lean on. So that's what we'll do. We'll lean on those stocks that have premium thick opportunities, and we'll sell that. We'll sell those puts. I guess occasionally we'll sell a call, but that requires a different type of an account. So most people, we can sell the puts. So that's what we'll do. Magic Warehouse is saying, you say you like to sell premium on expiration date, but with the ES, you are a buyer. How do you decide which approach you will take? No, essentially we're sellers. I mean, we create strategies that would create a debit, but really what we're counting on are the 2 short strikes that we put into that strategy, and that's what we're concentrating on. The other strikes are to give us that asymmetric trade. So that's what I mean. We're still 100% sellers of that premium, right? That's what we're there for. Hopefully that answers your question. But right now, it's just not there. Now, I guess what we could do is we could try selling premium against the ES or the SPY. The SPY is kind of rich. Maybe we could even sell premium against the VXX. Ken says, normally on a trial, after 4 losses out of 5 trades, I'd move on, but I'm only down $54 total. This is the kind of risk reward I can live with. Yeah, and you were in on that. I guess you were in on that first trade last week on Monday, a week ago, where we made 1,100%. I don't know if you made the 1,100%, Ken, but you probably made enough to cover the last 4 trades that were losers. Some people made enough to cover the next 8 trades, right? And yeah, those are the kind of opportunities that we have. Those are the kind of asymmetric opportunities. So what we're going to do now is we're going to just sit back and we're going to pick our spots. We'll look at selling premium in the meantime, and we'll try to make some money that way. We're going to look for easy ways to make some money because it's essentially the same thing. We're looking to get to that last, or closer and closer to that last day of expiration and grab as much of that premium as possible. Steady Rock Bad Boy, that's a great name. The truth is this: if any system works out, you could lose 9 out of 10 trades and break even. That is true. That is very true. You could lose 9 out of 10 trades and still break even. And that's the way it's been, in the, well, like I said, in the past 3 months, it was wonderful. Lost, I think, 2 trades out of 40 or something ridiculous like that. And some of them were nice, solid wins. Usually about 100 to 200% of the risk that we take on, which in of itself sounds like it's totally outrageous, right? But those are our small wins. And then occasionally we would have a big win where we would win 500, 900, 1,500% of the risk that we would take on. So that's what I mean by the asymmetric opportunity. So now, we're at a point where those opportunities simply aren't there. So we need to brush up. I think what you do is you spend this time to brush up on your execution skills. You brush up on your knowledge of the system. You study past trades. You look for those opportunities, and we'll also look for ways to sell premium. Anyone complaining is putting too much money on the line. Yes, they're either putting too much money on the line, or they're just new traders, or they're steeped in the old ways. All right, they think that there always has to be a game going, but there doesn't. And I'm, in this service, I tell it like it is. I don't know how this will help bringing on new trial members, but we have a 4-week trial, and if you go through that entire 4 weeks and then decide to take on the service, I will credit that entire cost of that trial. It's $20 a week, and I'll credit the full $80 towards the membership, which it really isn't a whole lot. And I guarantee you that you're going to get an education like none other, where you'll actually learn how to trade with a true edge. So that's where we're at. Volatility is a bitch. And unfortunately, we didn't get that pullback that I was hoping for. See, we're in that kind of position, which is contrary, I think, to what most traders have, where they're kind of trying to avoid volatility. We welcome it. We want that volatility because that's our lifeblood. Give us that volatility, man. And I thought we had it this morning with that pullback, but it looks like we're going. Let's see where we're at. I just want to check this. And how far back have we? Not bad. We've returned about half of what we lost. I don't know. I think if we go up another, if we get beyond 43.30 on the E-mini futures, I think there's a good chance that we'll regain the previous level of 43.40, maybe even 43.45. We'll see. So there is a good chance that we'll have negated this entire move down by the end of the day, which is crazy. At some point, the market has to give it up. That's, I'm fooling myself. It doesn't have to give it up. It can do whatever the hell it wants. But anyways, if you're interested in learning this strategy, and in particular the put selling strategy, I think you'll find that with the put selling strategy, we're looking to make anywhere from 3 to 6% per month. So you can increase your, I think that's a good target to choose, or to shoot for. If we have the Zero DTE working, I think that you can actually improve upon that even more. But right now, it's not quite there. So again, if you're interested in joining, the link's below. I want to thank everybody for coming on. Thank you for the questions. And we'll see you tomorrow, actually. Tomorrow is day 2 of this week, which is unusual. Usually we have a day in between. So we'll see you tomorrow. Have a good one. Thank you. Take care. Where's that off button? There it is. Take care.